I am going to pop the hood, rip the curtain, open the kimono, if you want to use whatever cliche, on how VCs really make decisions on whether to invest or not to invest in your startup. And this is information that I get directly from VCs and just a general outline of a process that I've used before and the funds that I've worked with have used before. Really, how venture capitalists, and we're talking about institutional money, I'm not talking about angels per se, like really early stage investors or friends, family, and associate investors who kind of YOLO their money or FOMO their money in and say, hey, I'm going to do it. I'm talking about institutional capital, VC money at any stage, how they make decisions and what you can look forward to. And this is something a lot of founders don't really consider. They just automatically think, okay, I'm going to build something. If you build something, that's half the battle right there. But then there's this whole process of actually pitching and then going through the process of securing that investment. Again, no matter what stage that you are raising capital, it just gets worse. The bigger the numbers and later the stage, the more rigmarole that you have to go through, unless you are sitting on a unicorn, baby unicorn, riding a rocket ship to the moon, and investors are just FOMOing their money and they're sending you term sheets because they're super scared you're going to take somebody else's money, which is so rare. And in this economic downturn, not going to happen. So you might as well just give up kind of that fantasy that you're going to show an investor a napkin, at a bar, and they're going to write a number and, all this stuff. It just doesn't happen that way. So let's take a closer examination. Like I said, this is straight from the individuals who are making decisions at venture capital funds that I have spoken to, and everybody's a little different, but I'm going to show you the general outline so you know what to expect. So let's take a look at this. So in the beginning, there's the whole screening process, and that's where you're kind of contacting them and you're submitting. Maybe you've got a warm introduction and they're going to look through and they're going to say, okay, this is something worth considering. There's a lot of decks and one pagers that the VCs will look at or their scouting department will look at, and they'll just quickly go through, maybe spend a few minutes and then say, okay, which ones can we go to the next round through this more rigorous screening process. And like I said, the majority of startups will not make it past the screening phase. But here's what will happen. Normally, there's like an investment committee or a team that gets together, and they're going to look at the startup and they're going to say, does the startup fit our investment thesis? Is pretty much what happens. So every fund has an investment thesis. They say, we are going to invest in these types of startups, and this is how we're going to generate return for our investors. You have to remember, funds are made up of multiple parties. There is a general partner. So a GP goes to the limited partners and they say, give me your money. I have an investment thesis. And then what's going to happen is I'm going to return the money with all these returns. So please give me, $10 million, $20 million. And here's my investment thesis. These are the types of startups that we're going to invest in. Here are the returns. And if it's an early stage, there's an early stage investment thesis of the types of startups that they're looking for. And that's what happens. So the general partner doesn't just get to willy-nilly the money on anything that they want. If you're watching my series on Silicon Valley, there's this one general partner named Peter Gregory, and he's just using money. He must have a ton of superpowers or authority over that money, because it's kind of funny the way that he's investing the limited partner's money. But what happens is it's got to be an investment thesis. So the general partner goes to the people that, I want your money to invest in startups. I'll go find startups. I have this investment thesis. And that's going to be the type of founder that they're looking for, the location of the startup. And that's a major deal. Like, are you incorporated in the US? Is it international? And a lot of people go, oh, that shouldn't be a problem. That is a problem, because a lot of funds won't invest if you are not in the same country, and unless they've got an office somewhere else, et cetera. So that is a major consideration there. where you're incorporated, which is the reason, let's say I'm in Canada. If I went and got into an accelerator or got a VC to invest in my company, most likely they would ask me to reincorporate everything in the United States. And what's going to happen is if I've already got partners or shareholders in Canada, that becomes a sticky situation, et cetera, lots of paperwork, decisions to be made. Then what's going to happen is, what is the funding stage? So like I said, there's an investment thesis. We only invest in seed stage companies. We don't invest in pre-seed, et cetera. If you don't know the stages of the company, go look that up. There's pre-seed, seed, and then you get into your price rounds normally in terms of A round, B round, C, D, E, F, G, whatever, until you go public or there's a major exit. And so the fund has an investment thesis that we invest in certain stages. So if it's a growth fund, they're probably looking at a series A and beyond, et cetera. And then there's pre-seed, et cetera. So the funding stage does a fit, and the domain expertise. So who's the founder, and does the founder have the domain expertise? And is it in the verticals or the particular areas that we want to invest in? They're going to match that up. And that's important to be able to demonstrate. It's extremely important. Or the founder has just got such a unique insight. But if the founder comes with a certain pedigree, so for example, let's say the founder worked in a cybersecurity company, and that cybersecurity company exited for $100 million, and it was all over TechCrunch, and that founder goes and starts something else in a new funky technology in cybersecurity. Obviously, there's domain expertise that would line up if the investment thesis is we as a fund want to invest in cybersecurity. So all these things got to match up. And you can imagine all the different types of verticals, industries, markets, stages. And you look at all the permutation combinations, not all investors are equal. And so founders don't feel bad if they're like, it just doesn't fit into our investment thesis. Well, you're not going to change their mind on that. And then obviously there's traction or there's some type of validation. So the earlier stage you are, the less traction validation you need. The later stages, you got to show growth and, what have you. So often VCs will give you a rejection and say, we like everything, but come back to us once you've gotten more traction, when you've reached a certain MRR or ARR or, projection or run rate, et cetera. Okay. So that's what's going to happen at the screening stage. Now, let's say you tick all the boxes and you get to the next stage, which is a very small percentage. You can imagine how many startups are pitching these VCs and sending applications and pitch decks and what have you. So let's say you get past this stage. And as an advisor, I'm helping you get past the stage. But in the back of my mind, I'm like, wow, if you get past this stage, congratulations. But oh my gosh, it is far from over, because then you're going to get into this concept of they're going to look at the investment history. So these are the important things that happens with investment history. Who are the current investors? If you already have like your Uncle Bob or your rich aunt who was a real estate investor or cashed out on some Bitcoin and YOLO'd some money in, that doesn't move the needle. So they want to look at the current investors. If you have a recognizable current investor, maybe an angel that's got some professional credibility, pedigree, then that's going to move the needle. And then they want to look at what's remaining on the round. A lot of founders don't consider this. Let's say you're in this pre-seed stage or seed stage. Let's just make it even and say you're raising $1 million in the seed stage, and you've gone out and you've raised $200,000. Well, that's going to be taken into account by the VC. Do we have enough dry powder? Do we write checks? Do we believe they're going to keep going, et cetera? And so they don't usually like to be first. And that's the reason you want to get some angels in. And let's say you're at $500,000 and they're like, yeah, we write checks for 500 grand. It completes the round. They can move on. We like the previous investors. Let's write that check. So that's what they're going to be looking at. Again, all these factors that founders need to consider. And then, as I talked about, remaining funding. So, I jumped ahead on that. So how much is remaining on the round? And then they're going to look at, is this a potential unicorn? So say they like all this stuff, they're going to look at the market. And usually this has kind of become apparent, but they're really going to drill in. is the TAM worth it, which is total addressable market? Is this a unicorn? So they will beat up the TAM. So they will go research and they say, are there really enough users? Do enough people have this problem for it to become a unicorn, which is a startup valued at $1 billion, which typically means if you're building technology, $100 million in revenue. So let's say, for example, that, for, again, round numbers, you're going to look at, $1 million. Okay, let's say it's a SaaS platform and you're in like super cybersecurity or just something that requires $1 million from every client, like your Palantir. Okay. And what happens is they'll look at it and they say, do we really believe 100 companies will pay this startup $1 million a year? And they'll go back and say, are these the founders that are going to do it? Do they have the right product, the right go-to-market strategy? Do they have the domain expertise, et cetera? They're going to beat up that TAM and they're going to say, is this really a unicorn in the making? This is where many founders go, yeah, but Ed, not everybody wants a unicorn. Well, actually, when you're talking about institutional capital, yes, they do, because think about it. If you have a fund, let's say you go out and raise $1 million and you're going to chunk in $1 million, or you raise $100 million. So you're a general partner. You're going to raise $100 million. You're going to chunk $1 million into 100 startups. How many of those startups are going to fail and never get to unicorn status? 97, of them, maybe 5 of them get acquired and you break even, but you only need one unicorn to go and be worth $1 billion. Okay. And let's say that startup owns 20% of that $1 billion. That's $200 million. Okay. Now you've doubled your money, which isn't even a great return. So what they're looking for is how many times can they make bets on startups with this asymmetric upside that are going to go 10x, 50x, 100x. And that's the name of the game. And that's the reason funds need to hit these massive home runs. They're not interested in the company that's going to do $10 million a year. I'd be interested in founding a startup that does $10 million a year. Sign me up any day of the week, but I'm not going to get VC money for that. And that's the reason I was talking to a founder that really illustrated this. I was sitting down with him and he just said, I think they raised $8 million and then they realized they just don't have enough TAM. The market is not as big as they thought it would be. So they began working and they changed their plans to go for a nice 2x return on the investor's money. And they gave up their dreams of building a unicorn. That was realistic for them. And I applauded this founder for taking such a measured and realistic approach. And unfortunately, this happens over and over again, that sometimes the problem that you're solving is not a big enough problem for not enough of a market to warrant VC money because they are looking for unicorns. So after you get to that, let's say you pass all that, they're like, okay, everything checks out. Now they're going to inform you, congratulations, you made it past the screening round. Now we're going to go into what's called socialization, or some VCs call it discovery. And this is what happens during this phase. You're going to have a lot of meetings, and they're going to want to meet with all your founders, team, investors, board. They may start talking to customers, etc. You're going to have a lot of meetings, and they're going to have meetings. They're going to ask you questions. They're going to ask you to prepare some presentations and PowerPoints and address certain issues that they have. And they're really going to test you. Have you thought through all the things related to making this startup happen, which is what, if you see in a previous video called the idea maze, have you really thought through the entire maze of all the left turns and the dead ends that you can run into? So they're going to meeting you to death. There's going to be so many meetings, and it's going to seem like, oh, they just keep kicking the tires, etc. You have to understand something. VCs, once you're at this stage, they want to invest. They are looking for anything to help them make the decision to invest, because most likely, if you're sitting on a unicorn, it probably looks like a dumb idea. It looks like one of those ideas that's never going to work. But if it does work, it's going to absolutely change the world. Case in point, renting out spare rooms to strangers, Airbnb, ephemeral text messaging, multimedia messaging, Snapchat. I know all these companies are getting slaughtered on valuations right now at this time in the market, but these were ideas that people thought, okay, that's just not a smart idea, but some people had visionaries and they thought it was going to work. I remember the story about LinkedIn when LinkedIn started and they said, we're going to make people publish their real names and their professional history on their social media, kind of like what was MySpace for professionals, but with real names. And people thought that's the dumbest idea ever. Nobody's going to go for that. Well, look at where we are now. Those ideas look really smart now in hindsight, but back then it was a big risk on whether or not people would adopt this. And obviously things start to work out for these companies, but they're going to meeting you to death, but they are looking for reasons to invest. And they just want to make sure that you can dot your I's and cross your T's. They will have meetings and they will verify with all the other people. So you have to be prepared for this. The next is they're going to go through their evaluation models. And often these are called rubrics. So every fund has got to go out and basically fill out these models and say, does this all check out? You know, they'll have formulas and et cetera. And they'll say, where are all the boxes? And they'll pretty much look, and they're going to look through your financial model, and they're just going to make some decisions because they need to have that to justify going to the limited partners and say, we've made this decision to invest in these companies because it's checked all the boxes. It works out. So it's kind of like analytics for investors or VC capital. So they're going to go through all their evaluation models, and every fund is different. They do things in a different way depending on, it's kind of like, I've worked in immigration before, and it's kind of like when you apply for immigration, you go through this point system and they score points based on, do you speak English? What level of education they have, et cetera. And so the government has a rubric to determine who gets a visa to enter into the country or permanent residence in Canada or a green card in the United States. After you get through socialization, let's say everything checks the box. You're not done yet. Now they're going to go through diligence. Okay. This is where they've decided everything is good, but now they're looking for all the traps, the booby traps, the little hidden things that are going to happen. And so they're going to do 360-degree interviews. They're going to interview as many people as they think are important, and they'll probably just interview all again. A lot of times they'll interview customers. They'll go out in the market and they'll do diligence on the market independent of you to just continue to look up. And by this time, they're saying, okay, what are the gaps that we need to fill? Let's go talk to this person, et cetera. And they're just going to do 360 degrees of interviews, meaning that everybody can be subject to this type of interview. Then they're going to go through the finances and the legal. Now they're going to really look through your books and your minute books and et cetera, et cetera. And they're going to look for any shenanigans that you've pulled. A lot of times there's a code, like a deeper type of code audit. It goes into deeper diligence, et cetera. And they're going to just make sure that there's no snafus or potential booby traps that are going to hurt their investment later on. So you got to have everything prepared. By this time, you've got lawyers involved, you got accountants involved, if you haven't kept proper cleanup of all your books, et cetera. And yeah, it gets kind of expensive. You have to understand that a lot of times you're going to raise money, and a portion of that is going to go to legal fees and all your administrative cleanup, et cetera. So you're going to go through the diligence phase, and then the general partner is going to make a decision. And guess what? You might have 5 companies that go through and get to the decision phase, and still there's not enough dry powder or investment to go around. And so that general partner is going to say, thank you, team, for bringing me these amazing deals. And they're all going to look at it. And then the general partner is going to make a decision. And most likely it's not going to be you. I'm just letting you know. And I'm not trying to spread doom and gloom when it comes to this. Believe me, something that's going to really help founders going through this is you keep working on your startup. Keep grinding away and getting that traction so that you can tell the potential investors, hey, look at the progress that we're making, and you're updating them as they're making the decision. But most of the time, if you've got everything in order, this could actually take a month, 3 3 months and you've got a decision, month to 3 months. That's how I've seen it, how long I've seen it taken. Now, how long does that take for the money to hit the bank? Well, usually another month after that, or sometimes even longer because there's lots of delays and what have you. So we're talking about if everything lines up, minus the time that you've spent building your startup, getting the traction, getting those early stage investors, friends, family, and associate investors to come on board to make your company look good, give you some validation. And then you get through this, and the time that it takes cold calling investors and applying to VC firms, which could take 6 months before you get a bite out of there. Then you got to go through this. And if you're lucky, it takes a month for you to get a check. Most likely, you're looking at about 3 months to go through this process. And then it takes even longer for the money to hit the door, get into the bank, which is the reason you start this process. If you are at 12 months runway, you really need to be thinking about your fundraising strategy. Trying to go through this and raising when you have 3 months runway, investors aren't going to invest, because by the time they're done, you're dead in the water. Your company has run out of money. And so it's the worst time. So if you are a year out and you're looking at it and your company is not going to reach default alive, meaning that if no other investment came in, et cetera, your company would be $1 profitable and at least break even, then you are in trouble if you don't really consider raising the capital at that time. And again, first-time founders really don't think about this ahead of time. And so it's hard. It's hard learning all these things, which is the reason communities like startups.com exists, with us advisors and people to really just guide you through the process and kind of give you the straight dope, the reality of what is going to happen during a fundraise. So that is how it works. Again, it's generalized. There are differences here and there, but you're going to get a solid idea of what you're going to look forward to in the soul-sucking process of trying to raise capital for your startup from institutional investors, venture capital. Hope this has been helpful. This has been part of the Office Hours series. If you need more questions, feel free to ask me, especially if you're in the startups.com community. We're running regular workshops on a weekly and monthly basis for all the founders who are in this funding, where we'll explain this to you and more. You can always talk to your fellow founders as well about the experiences that they're going through, and just get ready, strap in, and get ready for some really hard work. Hope this has been helpful. See you in the next video.